What if the money sitting in your bank account could quietly grow and make more money for you every year? Most people hear about investing, but feel confused by complicated terms and strategies. The truth is, investing can actually be simple if you understand a few basic ideas. Most people save their money in a bank account and think that's enough. But the reality is that the interest banks pay is extremely small. In many cases, it's close to zero. Imagine putting $1 million in a savings account that pays only 0.01% interest. After 1 year, you would earn just about $100. That's not your money working hard for you. Now imagine that same money earning 10% each year. $1 million would generate around $100,000 annually. Even a 5% return would give you $50,000 every year. That difference shows the power of investing. The main reason people invest is because of something called compound growth. This means you earn returns not only on the money you invested, but also on the returns you earned before. For example, if you invest $1,000 and earn 10% in the first year, you will have $1,100. In the second year, the 10% return is calculated on $1,100 instead of the original $1,000. Over time, this process repeats, and your money grows faster and faster. If that $1,000 continued to grow at 10% every year, after 20 years, it could turn into more than $6,000. That growth happens simply because your money keeps earning money. Another important reason to invest is inflation. Inflation means that prices increase over time, which reduces the purchasing power of your money. For example, many years ago, a postage stamp cost only a few cents, but today it costs many times more. The service is the same, but the price has increased. If your money is not growing at a rate higher than inflation, its real value is slowly shrinking. Now let's talk about how people actually invest. There are several things you can invest in. Some people invest in businesses by buying stocks. If the company grows and becomes more valuable, the value of your investment can increase. Others invest in real estate, where properties may rise in value over time. Some even invest in collectibles, such as rare cards, art, or other valuable items. However, for beginners, one of the most common and practical ways to invest is through the stock market. Over long periods of time, the stock market has historically grown upward, even though there are occasional declines along the way. Sometimes the market falls for a few years, but over decades it is generally increased in value. A popular way to invest in the stock market is through something called an index fund. Instead of buying shares of one company, an index fund allows you to invest in many companies at the same time. It simply follows a stock index that represents a large group of businesses. For example, one well-known index tracks hundreds of major companies. When you invest in a fund that follows that index, your money is automatically spread across all of those companies. Large companies take up a bigger portion, while smaller ones take up a smaller portion. This approach provides diversification, which means your investment is not dependent on just one company's success. This strategy is especially useful for beginners because it removes the need to constantly research and choose individual stocks. Rather than trying to guess which company will perform best, you simply invest in the overall market and allow it to grow over time. Some investors prefer active trading, where they buy and sell stocks frequently while watching the market closely every day. But this requires time, experience, and a higher tolerance for risk. For many people, a long-term and passive investing approach is much simpler and less stressful. Your investment strategy should also depend on your personal situation. Someone who is young and has many years before retirement can usually take more risk because they have time to recover from market fluctuations. On the other hand, someone who plans to retire soon may prefer more stable and less risky investments. Another question people often ask is whether the entire stock market could ever collapse completely. While no one can predict the future with certainty, historically the market has always recovered from downturns. For the market to permanently fall to zero, it would likely mean the entire global financial system had collapsed, and at that point, there would be far bigger concerns than investments. When it comes to where you should invest, many people use either retirement accounts or brokerage accounts. Retirement accounts often provide tax advantages, but the money usually stays invested until retirement age. Brokerage accounts are more flexible, allowing you to buy and sell investments whenever you choose. Thanks to modern technology, investing is now easier than ever. In the past, people had to call a broker to place a trade. Today, you can open an account online and invest directly through an app or website. Another common question is when someone should start investing. The best answer is simple: start as early as possible. The earlier you begin, the more time your money has to grow through compounding. However, there are a few things you should take care of first. It's wise to pay off high-interest debt, build an emergency fund that can cover several months of expenses, and only invest money you will not need in the near future. As for how much money you need to start, the truth is you don't need a huge amount. What matters more is consistency. Investing small amounts regularly over time can still lead to significant growth. In the end, investing is not about getting rich overnight. It's about patience, discipline, and allowing time to work in your favor. By starting early, investing consistently, and focusing on long-term growth, your money can gradually build wealth and help secure your financial future. And that's the simple idea behind investing: letting your money work for you, instead of letting it sit still.